All right, everybody, welcome to our webinar tonight. This is Tom's Trade Essentials. This is session number 2, and we are going to be doing something called loophole spreading tonight. Before we do that, we are going to do a review of last week. We're going to do a quick review of calls, puts. We want to talk maybe a little bit about the homework and the case study, or the case study we were looking at involving Citigroup. All right. The rules here are very simple, guys. Just open your eyes and pay attention, because we want to show you what we believe the majority of people out there, especially that are option traders, are just simply not doing. All right. They're out there guessing. And in fact, I was looking at some of the financial channels after the market closed, and even the pros were sitting there scratching their heads trying to figure out what, other than retail sales, caused the market to have such a big move to the downside and then straight back up again to where we closed very close to, I know we were down huge, but we closed close to the highs of the day. When you look and see what the market ended up doing between 9:30 and 4 o'clock, it was absolutely rocking session. And so we'll get into a little bit more of that, and as it pertains to what I want to talk about here later in the program. But before we begin, I want to let you know, if you have questions, comments, etc., during the webinar, you can ask us right here on the Q&A tab. I have a handout for you today, so you'll be leaving with an extra special bonus. All right, for joining us on your Friday evening or Saturday morning, depending on where you are. Before we begin, however, I need to have you pay attention for a brief moment on the disclaimer you see here. Now, this disclaimer is it's up here, and you can view this to your heart's content by just simply pushing pause on the recording you'll be getting later this evening. But if I can point out a few things to you, the first part is stock and options trading have large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and options markets. Now, we're what we call rules-based traders. And what that means is that we develop rules, we back test those rules, and then after we feel comfortable with them, only then do we actually trade them, and we try to trade them as best as we can. You know, we trade to the rules to try to replicate the results. Because we back test, all right, we're using back tested data, which is also referred to as simulated data. And keep in mind that back tested data does not include things like volume. It may over or under compensate for that, and lack of liquidity. And no representations being made that no matter how good something looks in the past, that it can continue to do that well in the future. All right. The other thing is that me, Jay, and everyone else associated with Tom's Trading Room, we are your educators. We're not your brokers. You need a broker to trade with. You must meet certain requirements. And everything we're going to talk about tonight is in U.S. dollars unless noted otherwise. Jay, why don't you
Yes,
start off with the review and then toss it back over to me when you're done.
you got it. Good evening, everybody. Good morning, everybody. Like Tom said, wherever you are in the world, that's the sentiment we offer you. We just hope everything's going as well as it possibly can for you guys. Real quick on the option review, as it states up there in bullet points 1 and 2, it says blank to open and blank to close. And what that means on the blank is that could be buying to open or selling to open. Basically, folks, when you do open the trade, that means you're starting the trade. Back when you used to talk to a broker, you didn't have to necessarily specify that. They pretty much knew what it was, whether it was an open or a closed order. And as stated last week, an option is an agreement between you and the markets. When you, let's say, for example, are buying a call option, you're buying a call option to open. It means you're starting that trade or entering in an agreement with the markets in which you are buying the right to buy a stock at a specific price anytime up until the expiration date, the close of the date of expiration. Now that agreement, that buy to open call option, is going to stay open until either A, you close it, or B, expiration for the most part. When you have bought a call to open and you want to end the trade or end the agreement, you're going to sell that option to close. And again, when you're talking to a broker, it didn't matter. But now on these options order execution screens, they're going to have the drop-down box that you need to specify. Are you buying to close, or are you buying to open? Are you selling to open, or are you selling to close? So just know that you've got to specify open when you're starting the trade and close when you're ending the trade. And when it comes to the expiration factor, as it says there, if you're in the money even by a penny, the OCC, or Options Clearing Corp, can assign that stock to you. So if you bought a $35 call and the stock ends up at $35.05 on the close, you have a strong chance of getting assigned that stock at 35. Even though it's only 5 cents in the money, you know, the assumption by the OCC and, you know, the electronic systems will be that it's assigning you that stock into the account. Now remember, folks, our objective in buying to open these calls or puts are not to exercise our right to go buy the stock. We're looking to buy that option contract to open, and we're hoping to close that option at a higher price. So we want to sell for a higher price what we've purchased before expiration. Now, if you're out of the money, there's no worry about getting exercised or assigned at that price, because anything under 35, they're not going to, you know, stick it to you at that 35 if it's out of the money. Okay? So that's just a quick review on opening and closing trades, and just remember to do that on the options order execution screens. And if you're using that online broker and they're worth their salt, they should have some support people that can answer the phone lines and help you walk through placing these orders your first handfuls of times, or they should have a virtual trading account opportunity for you to practice as well. We're going to go over this Citigroup case study we showed last week now, and let me switch over to the tools. I have up here, I set the back test date to last Friday, 1/8, at the close of the market. That evening we were looking at Citigroup. I think we were looking at the Citigroup January 46 puts, and the bid ask was 118 by 122. It showed a mid price of 120. The entry debit of $120. Now this is based off, again, a one contract scenario. One contract is the rights to or controls 100 shares. So you would take that premium of $1.20 times 100 shares, and that equals your cost to open this trade, $120 cost. Now that was on Friday evening, and with the Tom's newsletter, these newsletters come out Friday evening. So, you know, when we're looking at Money Calendar, the start date is basically on the open or the beginning price for that trade day until the closing price on that ended date. So if you see something on Friday night, the trick is seeing what it is opening up, what it's opening up at on Monday morning, and you'd like to see it basically about the same price. You may have to pay a little bit more. You may even get a better price than us sometimes. And even though they're not recommendations, you know, these are observations of the tools on the newsletters of what we're seeing as a candidate for a trade. You know, the most important things for an option trader is what's the expected price move and by what time frame. So, you know, you can either get a little bit better price than us, a little bit worse price than us, or sometimes the same. But for the most part, what happened here is on January 8th, that was our closing price, 120. If we hit plus 1 day, it will forward all the data into the next trading day, which was January 11th, that Monday. And if you look down below here on the chart, you'll see that that big red down bar day was Friday, and this bar right here was that Monday. Now, it did open higher. It went down even lower than Friday's low. So it's possible you could have got that same entry price if you actually chose to do this for real at 120. Where it ended up on Monday was 70 to 73 cents. So, you know, if you bought it a little bit later than us on Monday, you might have got a better price than 120. If you got it at 120, it closed down on you by about 50 cents at the close of market on Monday. But let's just say you got it at 120. Let's look at the theoretical pricing models from the tools. And this was a 6-day trade, remember? It was 6 trade days. And then what we also had the expectations for was to close this or sell it by this Friday, today. And lo and behold, Citigroup had an earnings report that helped this trade out. And what we can do is we can go plus 1 day all we want, or we can go to the latest. If you click on latest, it will take us to today. And today was also, you know, the end date or the sell date for this Citigroup scenario. And so here's what you're looking at, folks. And Tom said this was sometimes for some people upwards of like a 3 times your money almost. So here's what we're looking at. We've got 120 entry, and the current bid-ask price is 335 by 375. Those are the closing prices. So if you waited to the close today, these are what the prices are you were looking at. Now, if you sold it on the open, you might have got the same price or even better. Who's to say? All right, let's take a look where she closed at. Look at that big gap down on that earnings report. Really helped the returns of this long put scenario. So it's going to calculate your rate of return on the natural mid quote and the most optimistic. Don't count on the most optimistic price, but that mid quote, that's called buying or selling in the spread. You know, if you want to just take the natural, even if you just sold this thing, ended your agreement at the bid price, you're selling it at 335 from a purchase of 120. Look at that, Tom. That's 179% return. Not bad for a week's work, right?
Yeah, I see that. And there's a couple questions that are coming up that I want to talk about as well. You also got to give credit to the S&P and the retail report, which was terrible this morning, and that drove a lot of this lower as well. But coming to assignment, because that's exactly what could have happened here. Have you let this thing just expire, right? Because you're more than a penny in the money here. You're
Big
4
time.
points. I mean, you're
Yeah.
almost 4 points in the money, and so over 3.5 points. So if you look at this, a couple questions: can you be assigned within a couple of hours to expiration? Assignment typically happens at the end of every day, so there's not a per se that someone's going to assign you in the middle of the day. Assignments usually happen after the close, and then they're divvied out, and then you end up getting an email from your broker either late that night or before the market opens with an assignment. Now, I can tell you this, the majority of assignments do not happen until expiration, so the easiest thing to do is just close your trade out before expiration is due. Now,
That's key.
the second question, this is a question that nobody's asking, okay, but I'm going to ask it because it's important. You see that slippage down there, that 335 by 375? So that's 40 cents right there, right, Jay?
Yes, it is.
Okay. So 40 cents on one contract. What's that end up being in dollars? I mean,
$40 per contract.
yeah, $40. I mean, hey, $40, maybe that's not a big deal to you. But if it's 10 contracts, it's 400. If it's 100 contracts, it's 4,000. And all of a sudden, it becomes something that's substantial. So if you look here, and let me just mention this as well, that spread between the bid and the offer. Okay, that's a round trip. That's if you were to buy it and sell it simultaneously. So for instance, if you bought this on Monday, then you maybe, if you bought it on the offer, then you absorbed half the spread on the buy side, and you're going to absorb the other half the spread on the sell side. But there's a way you can eliminate getting out of this and actually having only a penny on this trade. Does anybody know how to do that? And I can tell you, Kathy, you've got that's a good answer. Sell the middle of the spread. But here's the problem. When you get down to the final day of expiration, here's what happens. Volume goes up, but what direction does open interest go? What is always the direction of open interest? As we get closer and closer to expiration, it actually shrinks. It dries up. Okay? So it's kind of like, we're on the financial Titanic, if you will, and it's sinking, and everybody's grabbing a life raft, okay, before they're all out. It's the same thing as that. As open interest gets lower and lower and lower, fewer and fewer traders are willing to make a market, and that's how that spread gets wider. So how do you get around it? If you are long in the money puts and you have the money, or you have a broker that's smart, then you can buy this stock on the close, and then you can have your puts exercised to carry it away. So for instance, you have a 46 put. Your 46 put grants you the right to sell at 46. If you bought on the close today and you got 42 and a half, and that was doable since it was at $42.47 as a last. If you got 42 and a half, then you're basically able to now take this trade, and you're able to, again, you bought the stock, you then would exercise the puts, it takes it away, and you're actually getting the middle of the spread in most cases. All right, so that's something I wanted to let you guys know that is a way you could do that, and that's actually uh, like John's saying, executing the contract, or by executing or exercising the contract, you're basically exercising the contract against the stock. It's a little bit more advanced. Okay, I know a lot of people don't do that, so the obviously the first thing I do is sell. All right, and then when do you sell these things? Well, if you're selling an option that's expired on expiration day, you want to definitely do it by the final hour of the day. You don't want to wait till the last 10 minutes because that's where all the spread starts to get wide. So I wanted to just throw a few of those at you guys, just to think about as you go forward. If you're dealing with weekly options like we did in this particular case study last week. So it was a great case study. There was some homework that some folks were doing on this, and they were all from the 46 put, 47 put, 48 put, 49 put. 49 put even had a over 100% return in it, and that was in the money. So this was a great example. I love getting these examples. I got to tell you, I wish I could get examples like this every single week, case studies like this every single week. But we have to deal with the other case studies too, including losing ones. So
Right. Yeah, so it's a nice tweak that a lot of people probably, I know Kathy says thanks, she would have never thought of that, and that's probably the case with a lot of folks as well. So as Michael's saying here, Tommy says, I'm going to have to go back and watch this and understand this advice here and all, and that's what the recordings are for, folks. So definitely take advantage of the recordings. Alrighty, and then the other point on this, Tom, is having the cash available to do that. I mean, obviously, if you're going to exercise your right, you've got to have the cash to be able to pick up that stock.
That's right, and and then there's the other thing too, is that when you're looking at the cash to pick up the stock, remember, if you have a margin account, it's half of that, and then if your broker is exercise that put option at the close, immediately following the close, you're not putting any cash out overnight. I mean, wham bam, it's done. At the end of the day, your account is zeroed. Your cash is in your account from the value of what you paid for the stock, which is 42.5 in this example, and what you ultimately sold the stock for, which is 46. That's what you'd see in your account.
Without the commissions to do that, no.
Pretty cool. I know, and without the slippage too.
Right. All righty. Now, as great as this is, folks, the question becomes now, could this have been better? Was there a better trade opportunity? For all you folks that are fans of PETA, I mean no offense to this, but there are other ways to skin the cat. So, what could you have done with Citigroup besides just a long put? And that's, I think, what Tom's going to get into now. Some of you guys that are more experienced with the trading strategy spreads, you've got your put spreads, your call spreads. Are they credit spreads or debit spreads? Whatever you call them, what Tom and I and a lot of his readers and subscribers talk about or term this type of strategy he's going to show you is called a loophole trade. And so, Tom, if there's no other questions, I don't believe there are, just yet a couple of comments there and all.
Yeah, no, I think
that wraps it up.
Yeah, and then
all right. I will turn it over to you.
Great. We'll do another Q&A session here at the end of this. What I want to do. So guys, I'm going to do something called the loophole trade, and it's kind of a phrase that I coined. Me and some partners of mine coined quite a while back, and I'll explain what that is. But we're also going to do another case study. So I thought I would start off with another case study. And we're going to pull this one also from the money calendar, but it's not coming from just the money calendar. It's coming from something called DarkNet too. So I'll explain what both of those are as quickly as I can. All right. So the case study we're going to be looking at, which starts on Monday, we thought instead of starting one today, let's go ahead and start one that actually happens, not Monday, Tuesday, because Monday is a trading holiday, and that is with Priceline. So pay attention here. But Priceline, we have a January 19th to February 25th pattern. All right. And so the pattern kind of looks like this. We're looking at on a 100% pattern. So 10 of the last 10 years during this time frame, Priceline.com has actually moved higher. Okay. The average trade in the last 10 years has been about 63 points. All right. However, when we look a little closer, which is what I like to do, then we see Well, what happened in those last 10 years? Well, about 6 of those last 10 years, we stayed below the $50 mark. And then all of a sudden we jump. In 2012, we jump 100 points. We had a little pullback in 2013. But look what happened in 2014 and 2015. These are points that it's solely because of price. So price has been jumping a lot in terms of point value. Now, I like to look at the last 10 years because it gives me a time when we had the financial crisis, number one. It also gives me an idea of what has happened recently, and it gives me still that nice average. But when I weighed in what's happened in the last 3 to 4 years, we got to put ourselves about 100 points, at least 100 points higher during this January 19th to February 25th time frame. Okay, let me show you what happened last year. And this is pretty indicative of what happened several of the years, is that we see, in this case, Priceline was trading at $1,000. And it moved up and it moved kind of back down. And by the way, down at the bottom here, you'll see this is the price of the stock. This is trading day 5, 10, 15, 20, 25, and so forth. And so as you move along here, you can see that we hugged the area where this started. And we slowly started moving higher. And then we had a gap, which was earnings. So what we've learned is that 10 of the last 10 years, we had a pop in the earnings, or we had an earnings report that ended up being positive for this stock. All right. It was most noted last year because guess what? The stock was trading a lot higher last year than it was in previous years, and it still is. Right. The high we got last year was close to $1,500 a share. Now, Priceline's pulled back quite a bit, which has actually made it another interesting and another strategy that we look at. And I want to talk about that, and that's called DarkNet. And DarkNet, which is also available at tomsoptiontools.com, DarkNet is our Elliott wave strategy. So what we were doing is we tried to figure out for the longest time how we could take movement and wave counts and that contrarian trading strategy. How could we take that and put it into a cloud-based technology or a browser-based technology like you see here? All right. So what we did was we found that a lot of these wave counts happen in what are called channels. And most people think of trend channels and they see, one trend channel going up or one trend channel going down, and you buy the low end of the channel and you sell the high end of the channel. And that's not the case here, because if that was the case, what in the heck is going on with this chart? Because it has in it some sideways, it has a little bit of up, and it has some down. It's all over the place. What we've done is we have a proprietary algorithm that looks at long, medium, and short-term channels. And when we get channel collisions, when we have channels colliding with each other, that gives us signals, buy and sell signals. And so we most recently got a buy signal in DarkNet on Priceline, right, just a few days ago. And so we like this because now there's two things happening. Number one, we have a seasonal buy on Priceline between now and February 25th. Number two, now the contrarian system is also screaming at us that it's time to take a look at this to the upside. And I got to tell you, it's very rare that we get two entirely different trading strategies on the same stock. It happened on October 1st of last year. It happened a couple of other times with the spiders with SPY. I think it happened with Apple once, and it did happen with Priceline before. And so, in fact, it did happen with Priceline back here in that at the end of September. And you can see what happened. We saw Priceline go for $1,200 a share all the way up to $1,450 before finally getting the exit at around $1,375. Nice move up. All right. And we're getting that again right now. We're getting some ideas that we're getting both contrarian a buy and also a seasonal buy. I like this. So I wanted to start off with just talking about an example, talking about a case study first instead of leaving the case study until the very end. Let's talk about the case study first, because now let's talk about what we can do with this case study. And by the way, I mentioned earnings. And I mentioned earnings on Priceline. I want to show you something which even further kind of confirms this in my mind as a great rules-based trade. So if you look at earnings reports like we do at tomsoptiontools.com, we have a multitude of data that we can look at. not only technically and not only mostly on options. I mean, most of our engine is options, but we've got technical and we've got fundamental data. And so as you can see here, what we did was we ran something called earnings effects. And our earnings effects are telling us that for Priceline, the last 4 quarters, we've managed before the earnings were announced, we got about a 3.5% move. In fact, last quarter it was 7% move before the earnings even came out, before the pop. And so that's good to know. The other piece, if you look down here at the bottom, so this is price. What does price do leading up to earnings? And this is just the few days before earnings. Look what happens with volatility. Volatility jumps on an average of 7.5%, a little bit less than 7.5%. So if you're buying that call option or you're buying options in general, you can be assured that in most cases, your theta gets temporarily put on hold. All right, and it gets replaced. It just gets infused with whatever direction the market's going. So when you get price moving up and you get volatility moving up, that's great. That's a great thing. All right, leading up to the pop. Now, when we get the pop, guess what happens? Price goes up a lot, but volatility goes down a lot. So that's the biggest risk we have trading into an earnings report and trading into something that has this extremely high price. So when you're looking at options, like, for instance, what are our options on Priceline.com between now and February 25th? Well, we could just buy the stock. You want to eliminate time value? That's the easiest way to do it. It's going to cost you, though, $110,000, roughly, for 100 shares of stock, right? Now, that's at the point where if there was nothing else for me to say, most of us would go ahead and get off this webinar and find something worthwhile to listen to. But what we want to do is move on. Now, Jay talked about call options. Remember, call options are the right to buy. And they're the right to buy for a set price, for a set amount of time with no obligation whatsoever, okay? Unless you let it become an obligation at expiration. You have rights. The person that sold you those calls have obligations. So you're paying a premium for these rights. And so if we were to look at Priceline call options at the close today, here's what I'm looking at. So I've got my strike prices, and then I've got my mid, my bid, and my offers. What's my IV doing? What's my percent to double look like? Which on calls is something, but we're going to do something a little different, and it's going to really shrink this down considerably. All right. Volume and open interest, again, is not something that I look at fairly when I'm looking at especially something like Priceline.com. I think you're going to see these two numbers. They'll go up significantly starting next week. All right, these are the February options. They expire on the 3rd Friday of February. And as you can see here, the stock was trading where? About 10, around that 10, I think 1085 area. It was one of the worst performers on a dollar amount for the day, 1086.74. So you're at the money options or the 1085s. Now, keep in mind, I'm looking for that 100 to 120 point move. All right, so I don't need to buy the 1085 calls if I expect that kind of a move to happen between now and February. And we know it's got a possibility of doing it because it makes moves like that all the time. So if you come down here and let's look at the 1125s. The 1125s are trading for about $34.95 mid-price. Right? So what's $34.95 going to cost us? Well, it's not going to cost us $110,000, but it is going to cost us $34.85, excuse me, $3,485 for this call option. All right, if we were to get it right in the middle, all right? So buying one of the February 16, 1125 calls, not cheap, all right? Not as expensive as owning a stock, but not cheap at all. And you know what your biggest risk here is when you do this? I'm going to show you. Here's your risk graph, all right? I pulled this right off of our website. And what we're looking at here is we got a lot of neat things here. We've got standard deviations, which gives us ideas of where this stock is likely to go. Then we have Bollinger Bands up here at the top, which gives us even a better idea of where the stock can rebound to. Now, what I did was I put $1,200 over here because that's basically where the price is on this horizontal line. $1,200 is also an interesting number because not only is it a round number, but it's a number that I feel Money Calendar is telling us that this could go to between now and February 25th. So if I come on over and I come across and I see where that black line is, that's my options expiration, and I come down, I can see, oh, so if I bought this call option, I could stand to make about $5,000 But if I'm wrong, guess what I could lose? I could lose that $3,485. That's a lot of risk on this trade. And yeah, I could probably get in here and say, well, if it goes below the low of yesterday, let me tell you something. That could happen Tuesday morning. We could get a pop down before we move higher. It's absolutely possible. We've seen it happen many other times, especially in volatile markets. So the example I have here with Priceline is, just looking at this, and I can see, all right, it has a little bit better than about 150 to 1 or 1.5 to 1 reward to risk ratio, but still that's a lot of risk. So again, and that's not the only risk on the trade. The risk on the trade is here. All right. This is what I call the 1%ers graph. 99% of option traders can find this stuff. They can find it on their broker's website. But guess what we look at? We look at things like what is the implied volatility? Where is it in terms of being hot and cold, in terms of being cheap or expensive? And as it gets more expensive, we've got to figure out ways of hedging this. So the what I call the 1%ers graph, 1% of all option traders look at option premium and look at implied volatility levels and how it will relate to movement in option premium. All right. Some of you in the room may be hearing something like this for the very first time. It's okay, because if you learn this more and more, it will sink in and you will become a better option trader for it. So that's looking at call risk graphs. So how can we lower this risk? One of the easiest ways of doing this is still maintaining that direction in the market is with what I call the loophole spread. And by taking our Priceline case study, I'm going to come back to it, but I want to talk a little bit about what this is. And this is called spreading, all right, or in this case, call spreading. So call spreading involves the use of more than one option in a single trade. And I'm not talking about 5 contracts or 10 contracts. I'm talking about option strikes. So we're going to take a look at a couple different option strikes. Call spreading can be done to lower your cost and lower your risk, because what you're going to do is you're going to have one call help finance the cost of the other. And because of that, it will also drastically reduce your day-to-day stress, especially in days like today. All right. So call spreading kind of looks like this. If you were to look at the risk graph of a call from both sides, you would have the long call and the short call. One person's on the buy side and the other person's on the sell side. The person on the buy side pays a premium, but for that premium, they have protection. And that's the protection that the worst case scenario that this call option can hurt you is however much you pay for the premium. And when you look at some of the stocks out there that have just gotten hit really hard, Amazon.com is one that comes to mind. Okay, Amazon was barreling in on $700 toward just not even a month ago. All right, hit $570 a share today, and that was the close. All right, because the low today was around 565. Now, that stock, let's say you put a weekly on that thing at the beginning of the week, and let's say you paid $15 for it. You'd be out $15 right now. I can assure you that. But with the stock sliding some 60 points in the last week, you suffered 25% of the risk of a stock trader. That's what having a long call option does for you. On the short side, why wouldn't, when the world would somebody sell something like this open? Well, I'll tell you what, short call traders made a lot of money this week, because not only did they sell calls and they took premium in because people thought the market was going higher, but the market went down, they got to keep that premium. The problem is they're obligated. In the event that this thing goes up and the call buyer makes money, you got to be making it off somebody. They're going to make it off the curve or the slope of the short call trader. So long call trader has limited risk and unlimited reward. Short call trader has limited reward and unlimited risk. You might wonder why people do this. And it's because of the probabilities of being right. So what we want to do is we want to be able to take the limitations of risk and increase our probability. So what we do is we do a combination of both. We buy these long calls at lower strike prices with the same expiration date, and simultaneously we will sell the short call with a higher strike price and, of course, the same expiration date. And so it looks like this when you look at it on a risk graph to expiration. This is an example. I'm just putting XYZ, 100, 120 call spread. Let's say you pay 5 points for it. So the 100, 120 call spread looks like this. The 100 gives you the right to buy XYZ, all right? And then the selling the 120 call is obligated. You're obligated to deliver that stock at 120. Look, if we could figure out how to buy at 100 and be forced to sell it at 120, we do it all day long. But that's basically what you're doing when you put this trade together. You're creating a spread in which you have the right to buy at 100, but you could be forced to get out of it for 120. This is the kind of assignment that you want because it will carry the whole trade away for maximum profit. So let's look back at our Priceline trade once again. So we looked at Priceline at the beginning of my presentation, and we talked about the fact that between January 19th and February 25th, that we were looking at a potential for Priceline to move higher. But because of earnings which are coming out on the 18th, we're actually going to shorten that a little bit because that earnings report usually accounts for most of the ending pop on this trade. So an example that I want to show you involves the February 1125 calls and the February 1150 calls. Now remember, we looked at these 1125 calls on their own, $3,485. But because we can now take in, if we sell the Feb 1150 calls, we're going to take in 25.9 points. And that will go against the $3,485 that we paid. Therefore, we have a spread debit, a net debit cost of, guess what? $895. Okay? So somebody's already asking, how do you get this cheaper? Well, you just move these strikes closer together. All right, if you put a 10-point strike, if you buy the 1150s and you sell the 1160s, you're going to do this for probably around 4 points. Okay, maybe a little bit less. All right, we'll take a look at it. We got some time to take a look at it. But that's the way we would look at this trade. And in fact, let's just go ahead. Let me move right now over to the software, and I'm going to bring up Priceline. I actually got Priceline up here right now, and we're looking at the price. Let me just reset this one more time, so we're looking at the most current prices. Update. All right, so I've updated the price, and I see 1086.74. That's correct. Now, I told you how much would it be if we bought the 11, let's say the 1125s, and we sold the 1135s. So -1, +1, -1. I'm going to come up here. I'm going to click on my risk graph. And this is going to give me that risk graph for what I'm looking for here on this trade. And what you'll see is you're going to see a 10-point spread, but it's going to cost us a lot less, $395. All right, so we have the ability to take in 153% return on that trade. Notice the trade, how it moves up. You have limited risk, but you also have limited reward. All right, and I show this in the presentation. Let me just get back to the presentation, and I just want to show you real quick what this looks like. All right, as we look at it on the actual spread itself. So the spread, as we were looking at it, $3,485. But here's what the actual risk graph looks like. So again, I'm showing you the $1,200 move. All right, that's on the calls. Let me move forward. There we go. Oh, I thought I had those out there for you guys. I apologize. For some reason, I'm missing something on here. Maybe that was the. Oh, I got it. Okay, let's try this one more time. I had up a different file. So here's our trade. Here we go. This is what I want to show you. So at $1,200, I'm sitting over here. All right, if I draw a line straight across, I realize that I am deep into the profit potential of this trade. Okay, because all we've got to do is get at or above 1,150, and by expiration, we've actually maxed out. All right, so what do call spreads do? Well, they lower your overall cost, they lower your overall risk, they lower the break even, and they do it better than the straight up call. And in this case, we have a 179% return on investment here on this 25-point spread. So what are we doing? You're looking at buying the February 1125, selling the February 1150. You've got 25-point spread between the two of them. And what are you paying for that? Less than $900, or less than 9 points out of a possible 25. And looking at the graph here, this really says it all, okay? Because what's happening is you want to hedge volatility, you look at this graph. And you look over here in this right-hand chart, because this is the graph most people look at that use our tools. And what we find is that if you're the more you're standing up, all right, the more hedged you are against volatility. The more that it slopes, if you see these things moving that are sloping sideways, you've got a very high vega trade, all right? That means your trade has a lot of vega risk in it. If it stands up more, you've got less vega risk. So keep that in mind. This one has much lower vega risk than putting on a call option on its own. So my plan with Priceline is the following. Loophole call spreads between now and February 19th. All right, that is the third Friday of expiration. I am utilizing the third Friday of expiration because we have an earnings report on Priceline on the 18th, one day before. So what's going to happen is Thursday afternoon, Priceline is going to announce their earnings. Friday morning, we don't know whether Priceline is going to go up or down. All right, I don't have a crystal ball. But when I see the same move happening over and over and over again, to me, I'm going to think it's going to happen. It's going to happen again because that's what patterns do. But it could go down. I will tell you what will go down. Volatility will go down on the 19th. And the reason we do this is because if you want that call spread, if it's in the money, you want it to roll up to as close to this area here, max profit, as possible. Then you got to get past the unknown, which is earnings, and that gets you into the known, which is then the volatility comes out, and what gets replaced for volatility? Price. Now, if you do more than one spread, all right, if you're a trader that trades more than one contract, then what I like to do is close out at least half my contracts at 100% profit. So if I put this on for 9 points, this is an example, by the way. There are several ways you can slice up Priceline. And there's no wrong answer as long as you're buying the lower strike call and you're selling the higher strike call and you feel it's within an area that you think Priceline is likely to go to. I'm using my tools. I don't do a lot of thinking, all right? My wife tells me I'm not real good at thinking. So I let the software do the thinking for me. And the software thinks. The software doesn't think either. It just acts based on past data. And what the software does is it's telling me about a 100-point move. And so as long as I'm in that 100-point range, buying lower, selling higher, then I should be fine based on what my rules are telling me. I want to close out half of this when it hits 100% profit. So if I were looking at this case study, if it got to 17 or 18, if it was filled at 9, if it gets to 18, I take half of them off. And then I want to close the remainder of this out by February 19th, by the close of February 19th, because that's where assignment could happen if you're in between, let's say, the long side and the short side. If this thing jumps, it's so far in the money, and you've got some on, and it's February 19th, let it go. Because what's going to happen is your long options are going to exercise, your short options are going to assign, and you're going to get the full value of that spread. So that's it. Questions. And then I got something really cool to show you. Oh, and while the questions are coming up, Jay, I'm going to send a quick little handout to everybody. So do you have any questions on the board, Jay, that you could see?
One was about the theta decay. The question was, why isn't it too little time? Won't the theta risk eat away at that trade?
No, it won't. It won't, and I'll tell you why. Do you know why, Jay?
Go for it.
Well, okay, I'll be the one to answer this question. As we get closer and closer to earnings, more and more chatter is going to be on all the radio shows and television, and all that stuff creates excitement, which excitement spills out into the form of volatility and higher option prices. So theta decay, theta may decay a little bit, but realize we're on both sides. We're selling too to help combat theta. But in those final 2 weeks before the earnings report comes out, I expect theta to flatline, and then it's going to drop like a stone on the actual options expiration day. So that's what I see.
Great. And then what made you pick the strikes you did?
Well, let's see. I looked at, once again, what I was looking at was, if I could just back up here a second. Let me pull up, I've got a couple of different things going on my screen here, guys, so I apologize. But if we were to go right back to the beginning of the slideshow that I was showing you, and we were looking there you go. So this more importantly. So why did I pick the strike prices that I did? Well, it's simple. Because if you look here in the last couple of years, we've saw some really huge moves that occurred And I'm actually sending you guys this whole presentation right here. So you've got it. It's coming down as a handout. You'll be able to pull it right off the screen right now. But if you look at the slide that I have up right now, which I believe is slide number 4 in your deck, and I sent it to you as a handout, so you'll get the handouts. But if you take a look at that slide right there, you'll see that we were looking at in the last 4 years, roughly a 100-point move up. So that's why I took today. I moved up 100 points or so, and then I said, all right, let me find something that can give me a 150% return within that move, and it doesn't even have to move half that distance to get it. That's why I picked what I did. I also like round numbers, okay? And round numbers are, I don't like 5s unless they're 25, 50, or 75, or 100, okay? Those I like. Round numbers like 1100, 1200 are the best. Then you go to the 50s, then you go to 25s, then you go to 10s. The 5s have the least amount of, unless they're at the money at the time, they really do have the least amount of volume in them, all right? And with Priceline, as you get farther and farther out of the money, not only does the premiums drop, but the spreads drop a little bit too. And this is one of those options that the spreads might look really wide, but you got to remember that the spread is based on a percentage of the actual stock. How many stocks out there do you know of that's trading over $1,000 a share? Not that many. All right, so it's important to know that too. All right. And let's see. Any more questions, Jay? Or did I just do a fabulous job at...
You knocked it out, yeah.
A lot of comments. A lot of comments. Thank you for the handout. You're welcome. And the handout is everything I discussed tonight, including the actual trade that we're looking at, which is, again, like I said, this is an expensive one. What I want you guys to do is go, you got the whole weekend. You got 3 days. You got 3 days. Pull something up. And, one of the things that we have on our tools is something called a what-if scenario, where you can go in and you can pull these graphs that say, what if Priceline goes up, and what if we lose a week to expiration? What is the theoretical values? We got scores of theoretical values you can get on these on these particular software pieces. On the data, you can go through immense amount of data. Richard says thanks for the C suggestion. He did pretty well. 2 days. That's awesome. It took most of us a week. Let me just ask you a question, Richard. Were you late to the party? Were you late to the C party? I'm just assuming you may be. Oh goodness. Jeff's asking for any comments on the VIX. Comments on the VIX is that, and I'm a little nervous because the VIX is not as high as I think it should be, which tells me that, come Tuesday, I'm really thinking we're going to get a wash either on Tuesday or I think the wash is going to come here this week. That's going to be my call. Based on everything I see, I think the wash is likely to come this week. So couple more things here, guys, as we kind of close out. And I want to just 2 quick things here for you. So let me find my chat window here. I want to share with you.
There's some commentary about some guys that are having some good success with this stuff, Tom. So they're saying thanks for the handout. Here's a guy thanking you for the tools and the education. He says even though he suffered some small loss when he started out, he followed you on a Priceline trade, and it paid for his yearly subscription.
Hey, you know what? I mean, the thing is, guys, is that I really want you to my whole purpose for you being here tonight is to teach you how to do this yourself. Okay, that's it. I mean, it's great that we have, that are, and I'm going to tell you, case studies are going to work, and then some aren't going to work. And the thing is that if you really want to, if you're serious about being in this business, you got to say to yourself, all right, I am going to lose money. That's part of this business. All right. I mean, it happens to me. And the day that I stop losing money is the day I stop trading because that's part of the business. It's like any business. Businesses are not about just pure profits. There are expenses, there is slippage, there are costs. And that's this business we're in is there's a cost there. Now, just quickly, the stuff that I used and the stuff that you can use if you haven't, check out the free trial. And what you do is if you go to Tom's Option Tools, let me just show you real quick where it is. So go to tomsoptiontools.com, Up here in the upper right-hand corner, you got the free 7-day trial, and that will give you access to the videos, to all the software that we're messing around with, the money calendar, DarkNet, and I'll send you videos too. All right, you try this out for 7 days. I'm going to send you 7 days of videos to show you how to create trades, how to scan, and even how to use Money Calendar and DarkNet, which those are actually small webinars that I'll be sending you copies of as well. So it's important that you get that. But it's just try it out for free and see what you think. Next, finally, what I want to share with you is what we're going to be doing next week, because this is really cool. All right. This is absolutely awesome. I hope all of you are here because, what we taught in the last couple of weeks was, we talked a little bit about calls and puts, and we talked a little bit about how we select things and what we use, but we're coming into earnings season. All right. And earnings season, we actually have a particular strategy we do. Mike Wade is the expert on this particular type of strategy, and we call it How I Trade Earnings Reports with 100% historical accuracy regardless of direction. Okay, we're going to show you exactly how we do this. I kind of coin it to your local ticket scalper at major events. All right, because if you look at ticket scalpers, they typically make a good living scalping tickets. Every once in a while, one of these guys gets greedy and they buy too much of one thing and something happens and they get left with a bunch of worthless tickets. We don't want to do that. We'll show you how we trade these earnings reports like a ticket scalper. And, you're basically in and all the excitement, and then all of a sudden you're out of tickets by the time the show starts. And that's what we're going to do. We're going to show you exactly how we do that, how we do strategy selection. We'll have live case studies as well. This will be myself and Mike Wade, and we're going to be talking about something called a straddle and a strangle. Okay, so we're going to really teach the basics of straddles and strangles. I'm going to spend a little bit of time on that, but what we really want to teach you is how the one percenters trade straddles. All right, very, very few people use what we want to show you next week on how to trade straddles, and like I said, it's something we teach once a year. You won't hear me talk about this again for the rest of the year. It'll be 2017 before we bring this up again. So you're in a very unique position right now, everyone, to where you're going to be able to hear Mike and I discuss our ticket scalping strategy when it comes to the markets. So that's our plan for next week. And guys, it is it's almost 9 o'clock. So Jay, any final comments before we close this up here for the night?
Well, there was a couple of people that asked what the wash means, or what do you mean by a wash? So I think what you're calling for is like an excessive sell-off. There's a lot of there's not a lot of
okay. When I heard wash for a second, I was thinking that some dirty laundry. No, the wash. What I talk about is a washout, where we I really thought today looked like it was going to be a washout day, but here's what ended up happening. If you look at like an hourly chart, or you look at a chart for the day, we started out and we moved lower, and then we kicked back up there in the last, I want to call it the last couple of hours of the day. But most of the move to the downside happened overnight last night. Okay, by the time it got into our lovely hands, we were at 1885 on the S&P. We traded all the way down to a low of 1849, and guess where we ended up closing? 1876, which was surprisingly not that far from where we opened. So that wasn't a washout day. Okay, a washout day would have been if we go straight down, and then the next day we go straight up, or we go straight down and straight up during a one trading session. I don't think we got it yet, and I think the VIX and the bond market are telling us that it maybe not quite there. I was looking for 160 on the bonds. We didn't get anywhere near it, so I think the fear factor still isn't. It's still kind of there. It's not a outright panic, but I'll tell you what. Most of the people that were at work today are coming home and they're looking at this mess and they're thinking, I'm going to sell everything on Tuesday. So that's why I'm thinking maybe there's a potential the wash could happen on Tuesday. But guys, come back and see us next week, and we're going to get into earnings season, and hopefully all of this mess between China and oil and retail sales and a couple of the other things that we had going on this week will be behind us, so we can actually start focusing on individual stocks instead of the entire gamut. So thanks again for being here. Jay. Mike will be here next week. Jay.
Mike's next week.
Yes, Jay.
Anytime throughout the week, guys, you have questions from this or anything else, remember, support@tomgentile.com, and then we got our phone Skype support, too, during U.S. market hours. Don't hesitate and wait till like once a week. If you got a question on Tuesday, don't wait till Friday. You may forget what it is. So hit us up as soon as you know and as soon as you can.
Absolutely, and I'll have the recorded session out to you guys as soon as I possibly can. Have a great weekend. Have a great 3-day weekend for those of you that are off on Monday. And we'll see you next week. Thanks, guys.